Now, according to USA.gov, at usa.gov/budget, the deficit is financed by the sale of Treasury securities, bonds, notes, and bills, which the government pays back with interest. Part of what the government spends money on each year is the interest owed on all years' deficits combined, or the national debt. So remember, the deficit is a negative balance, and including 2021, the United States has operated 46 years at a deficit and only 4 years at a surplus. There's a negative balance for each of the 46 years that the United States operated at a deficit, and the total amount of the combined deficit years is the national debt. One of the ways the deficit is financed is listed at datalab.usaspending.gov and reads as follows. The government can also use operating cash, which is available from an account at the Federal Reserve to pay for deficit spending. This would be similar to an individual using their debit card to pay for purchases. What is the Federal Reserve System? As stated on www.federalreserve.gov, the Federal Reserve System is the central bank of the United States, and it performs 5 general functions. As it conducts the nation's monetary policy, it promotes the stability of the financial system, it promotes the safety and soundness of individual financial institutions, it fosters payment and settlement system safety and efficiency, and it promotes consumer protection and community development. Now, where does the Federal Reserve get its money to purchase securities so the government can cover the deficit with operating cash? The Federal Reserve, through typing whatever amount it's in need of through computer keystrokes, creates the money it needs to purchase the securities so the government can cover the deficit through an operating cash loan. Remember, the money is created through computer keystrokes as a credit, with the money coming from nowhere to fund the credit. In a normal transaction, money has to come from somewhere to fund any credits, but not in the case of the Federal Reserve System purchases of securities to add liquidity to the banking system and/or lend money to the United States federal government. This is called quantitative easing. The money is created out of thin air, and this is confirmed by the words of former Federal Reserve Chairman Ben Bernanke, who was chairman of the Federal Reserve from 2006 to 2014, as Ben Bernanke confirmed these facts in a 60 Minutes interview. Let's look at the following video clip from the television show 60 Minutes, posted to YouTube by CBS, and listen to former Federal Reserve Chairman Ben Bernanke as he confirms Federal Reserve money creation out of thin air.
Balance sheet.
Is that tax money that the Fed is spending?
It's not tax money. The banks have accounts with the Fed much the same way that you have an account in a commercial bank. So to lend to a bank, we simply use the computer to mark up the size of the account that they have with the Fed.
These are the words of former Federal Reserve Chairman Ben Bernanke telling everyone how the Federal Reserve creates money by using computer keystrokes to mark up the size of the account that the bank has with the Fed. The money is not coming from a Federal Reserve account that has money in it to draw from to pay for the securities purchase, as in a normal transaction. The Federal Reserve has $0 to draw from. The Federal Reserve has no money to begin with, but still has the ability to purchase securities by marking up the size of the accounts banks have with the Fed without having any money to cover the markup. The next video clip will show how this is done. The Federal Reserve owned approximately $800 billion in securities at the beginning of the financial crisis. And in this video clip, Ben Bernanke stated that the Federal Reserve purchased $2 trillion of additional securities. Now, how did the Federal Reserve purchase $800 billion of securities with no money and later purchase $2 trillion additional in securities? The Federal Reserve had no money. The Federal Reserve had $0 to purchase the $800 billion of securities that were on their balance sheet. And the Federal Reserve had $0 to purchase $2 trillion additional dollars of securities. This second video clip will explain it in more detail. Now remember what Ben Bernanke stated in the first video clip.
Balance sheet. Is that tax money that the Fed is spending?
It's not tax money. The banks have accounts with the Fed much the same way that you have an account in a commercial bank. So to lend to a bank, we simply use the computer to mark up the size of the account that they have with the Fed.
In this second video clip, Ben Bernanke also confirms Federal Reserve System money creation out of thin air. In a 2012 college lecture posted on YouTube by the Federal Reserve. Now let's look at this second video clip.
Now, you might ask the question, well, the Fed's going out and buying $2 trillion of securities. How do we pay for that? And the answer is that we paid for those securities by crediting the bank accounts of the people who sold them to us. And those accounts at the banks showed up as reserves that the banks would hold with the Fed. So the Fed is a bank for the banks. Banks can hold deposit accounts with the Fed, essentially, and those are called reserve accounts. And so as the purchases of securities occurred, the way we paid for them was basically by increasing the amount of reserves that banks had in their accounts with the Fed. So you can see this here. This is the liability side of the Fed's balance sheet. Of course, assets and liabilities, including capital, have to be equal. So the liability side had also to rise near $3 trillion, as you can see.
Now, as Ben Bernanke stated in this second video clip, the Federal Reserve marked up the deposit accounts that the banks have with the Federal Reserve. And a reserve account is the same thing as a deposit account. And the Federal Reserve used a balance sheet to show a credit of money to the bank accounts of the securities dealers. No money was deducted from a Federal Reserve account to pay the securities dealers for the purchases. As in the case of a normal transaction, the Federal Reserve had no money. The Federal Reserve had $0, so there was nowhere to draw money from to pay the securities dealers for the purchases, as in the case of a normal transaction. The Federal Reserve had $800 billion of securities on their balance sheet before they increased the amount through computer keystrokes to approximately $3 trillion of securities, which includes both the $800 billion of securities and the $2 trillion of securities. The Federal Reserve increased their asset side of their balance sheet to approximately $3 trillion. And they increased their liability side of their balance sheet to approximately $3 trillion, which made both sides of the balance sheet equal and showed a money transaction when there was no money coming from a Federal Reserve account to pay for the securities purchase, as in the case of a normal transaction. The next video clip is from a PBS Frontline video posted to YouTube by PBS entitled "The Power of the Fed." Richard Fisher, the former president and CEO of the Federal Reserve Bank of Dallas, is speaking in the video clip. Now let's look at this video clip.
Further. And then the question was, what else can we do? And the committee came up with the idea of quantitative easing.
Quantitative easing. What in the world is that?
Quantitative easing. That's just a Greek term to a lot of people.
A lot of people want to know what they're going to say about what we call quantitative easing. What are some of the non-traditional...
Quantitative easing, or QE, was championed by Ben Bernanke, then the Fed chairman.
The Federal Reserve has been putting the pedal to the metal. So we're doing everything we can to support the economy, and we hope that that's going to, get us going next year sometime.
QE was an experimental way for the Fed to inject money into the financial system and lower long-term interest rates. The way they did it was to literally create new money, and use it to buy huge amounts of things like mortgage-backed securities and government debt from banks and other institutions. Their hope was that the lower rates would spark more spending and borrowing throughout the economy.
It's almost like alchemy. You can create money out of thin air if you're at the central bank. So creating more money puts more money in the banking system, put more money out there for the economy to take it and put it to work and to grow and to restore itself.
So as you have now seen and heard, the Federal Reserve System creates money out of thin air, and as a result, can undoubtedly create infinite amounts of money. We'll stop here for today, and we'll pick it up in the next video.